Hi, I'm James, and in this video, we're going to talk about the investment thesis, what it is and why you need to have one. So the idea for this video came from a conversation that I had with a friend of mine who I've been speaking about investing with for a few months now. And she sent me a message and she said, hey, this stock that I've invested in, it's gone up quite a lot and I'm thinking about selling it. Should I sell it? And so I said, hang on, let me ask a few questions. So she said, do you have time to chat? We had a conversation and I asked her, I said, why did you buy it in the first place? And so she proceeded to tell me why. And then I said, okay, well, did you buy it at a good price? And is the company doing well? And then I also asked, what's your investment horizon? Do you want to make a quick buck or are you looking for long-term investments? And so just having that conversation, I sort of realized that she didn't really have a clear investment thesis. And so when the price moved, she was thinking, oh, what do I do? Do I sell? Do I buy? What do I do? And so I think it's really important that we need to think about why we're buying things when we are investing our money, so that when the price moves, we're able to have a bit of a plan of what we might do. What happens if it goes up? Do we sell some? Or do we buy more? What happens if it goes down? Do we panic and we sell it? Or is that an opportunity to buy something at a discount? So what is an investment thesis? An investment thesis is basically our reasoning for buying a particular investment. So there are a number of different ways to look at an investment thesis, but I like to break it down into three parts. Number one is, what is the investment we're actually buying? So, is it a business? If so, what are the fundamentals of that business? How good is it at making money? Do we understand its fundamental value? Have we dug a little bit of, have we dug into it and looked at some of its ratios to see if it's undervalued or not? Number two is, why are we investing in it? Are we investing in this stock because it's a renewable energy company and we want to align our ethics with our investments? Or is it because it's very profitable, it's got a good management team, and we're looking to make money over the long term? And then number three is, when do we plan on selling, if at all? So that way we can come up with a bit of a plan of, well, if the price goes up, should we sell in the next 6 months? Or are we planning to hold this for a longer time period? Now, the reasons that go into this third part can be to do with how long we're investing. Are we going to retire soon? Or are we actually starting our investing career, because we're in our 20s or 30s and we're looking to have longer term investments over the next 10, 20 years? So I think it's really important that we keep it simple. Now, this is like a bit of a structured approach, but I think it's good to make it concise and not, overcomplicate things, so that we're actually pretty clear on what we're doing, at least for ourselves. Now, the benefit of this is it allows us to be proactive with our investing decisions rather than reactive and emotional. Let's just say the market crashes overnight, 20, 30%, our particular stock drops dramatically. If we haven't really thought about what we've bought, why we've bought it, and when we plan to sell, we might see that and then panic and think, oh crap, everyone else is selling. Maybe they know something I don't, I should sell too. Whereas if we have thought about this and we have a clear investment thesis, then we can see the price drop 20, 30% and say, oh, this might be a great opportunity for us to buy some more. Or we might say, hang on a minute, why did it drop? And then we dig a little deeper and we find out, there's been some breaking news about some scandal, and maybe that's a good time for us to update or change our investment thesis and say, what? It's no longer what I invested in. A great example of that could be the airlines. You may have bought into Qantas last year when it was around $7 a share, but seeing that it hit around $2, low $2, $2.50 a share in March, looking at it now, it's around $3.50 or something, but it's fundamentally a different company now because it's taken on a lot more debt. We can expect that the travel industry is going to be hurt for at least the next couple of years. it's likely that it's not going to be operating at the same capacity that it was before. So that kind of investment, it's changed. So that's where we'd have to rethink what our investment thesis is for something like that. Now, I'll give you an example of a personal investment thesis of mine. So one of my holdings, which is around 20% of my equities portfolio, is IOZ. IOZ is an ASX 200 ETF, which just means it's an ETF that owns the top 200 companies on the ASX. So if we use the template of what, why, and when, well, I can pretty easily say what it is. It's an ETF that has a really low management fee that owns the top 200 companies on the ASX, which gives good portfolio diversification. So why did I buy it? Well, I wanted a safe, slow growth investment with that ETF. I wanted something that had good diversification that wouldn't require me to analyze all these companies and put a lot of effort and work into. I wanted something that was quite passive and easy to hold on to over a long period of time. So that comes to the third point, why? So that brings us to our third point, when? Well, when for me, I don't plan to sell anytime soon. And as a matter of fact, if I see another big drop in the market, I would consider putting a little bit more money into buying more of that ETF, buying more shares of that ETF, so that I can keep that nice solid base of a well-diversified portfolio within my overall equities portfolio, which includes very specific investments in certain companies. So to break down how you might form your own investment thesis for some of your investments, I'll give you a few pointers of the things that I would like to think about, and maybe you could too. So the first part is knowing what you're buying. Now, a great way that I like to articulate this is to think about the 3 areas of a company that I highlighted in my last video, and I'll link it up here somewhere. But basically it comes down to 3 things, and it is, what is the financial position of the company right now? 2, how good is that company at making money? And 3, where does it spend its money? Where does it spend its cash? Is it investing, expanding, or is it selling off its assets to try to cover its expenses because it's a sinking ship? So that's knowing what you've bought. Now, the next part is around knowing why you've bought it. Now, for this, I think it's really important to think about, what kind of approach that you want to have with your investments, or maybe why you might be investing in a particular industry. So for example, there's a stock that I'm watching very closely called NXT or NextDC. And this is a company that I think has amazing potential. And while I don't currently invest in it, I'm waiting for its price to pull back. I'm hoping that it does, to a target that I have for that stock where I'm going to start investing into that one. Now, my why for that will be, I have a number of reasons, but to give you some food for thought, it's because it's in a growth area that I have a reasonable understanding of, which is cloud computing. And that's it's a huge trend that we're moving toward. And I see huge potential for NXT to do incredibly well over the next 5 to 10 years. So that's kind of aligned with a bigger trend. Now, the why question for you, it could be as simple as, it's aligned with a growth area that I think has a lot of potential for the future. And that's the way you might think about it. Or maybe you might be investing in a renewable energies company because you want to invest in things that align with your personal values. Now, the third part is around when you're going to sell and for what price, maybe you want to buy more. Now, the important thing to think about here is how long are we planning to invest for? Some of our holdings, we might want to just buy and hold forever, until we retire. Whereas other holdings, we might want to buy and then, speculate on for a year or two and then reassess and say, hang on a minute, is it an area that we think could have a lot of growth in the short term that we can buy it now and sell it off later? at a greater profit and then reallocate that? Or is it something that we think has a more longer term view? Now, an example of that for me is I've recently invested in both gold and silver, and I've done this through ETFs. Now for me, my reason for that, specifically for the when, is I've got a sort of 2 to 3, 1, 2, 3 year time horizon of when I'm looking to actually sell those, and I've got my price targets. So for example, for my gold and silver holdings, we'll start with silver. When it goes up by 2 times what I've paid for it, then I plan to sell quite a substantial percentage of that holding to then reallocate into something else. If it triples, that's when I'll sell more of my holding that remains. And then if it quadruples, which could happen as it did in 2008 after the GFC, if that happens, then I will sell off the remainder of my holding of silver and then reallocate it into other investments that I'm interested in at the time. Alternatively, if it only triples over that 3-year period, although only, I say that lightly, but you know what I mean. If it triples, but it doesn't quadruple, then I'll just hold that remaining amount in my portfolio and then reassess at that point in time how I might update my strategy and my, my investment thesis. Whereas for gold, I'm anticipating my gold will at least double in the next 2 years. And that might not happen. And if it doesn't, then I'm just going to hold that gold until it eventually does. But if it does, then I will sell off a portion, maybe 50% of my holding, once it reaches that milestone, and follow the same kind of approach that I've just described for silver. Now, the same can be said for other holdings. So let's just say I was personally invested in NXT, which I'm not yet. But if I was, then I know enough about that business, and I've looked at their financials and I've done a bit of analysis, that if the price were to go down by 20-30% and I were holding it, I know I would be putting more and more money and just averaging my way into it on the way down, because I wouldn't be afraid of what the market thought its price was, because I understood what my investment thesis is, which means I know why I bought it and what it is that I've bought. And if I know what it is that I've bought, it's really easy for me to see, oh, it's dropped 50%. Well, I understand the financials, so that's a great bargain for me. I'm willing to buy more. But if it goes up 50%, well, I might say, you know what? I planned to hold this for 5 to 10 years before considering selling. So even if it doubles in price, I'm going to say, you know what? I'm actually going to hold. I'm not going to sell off anymore, because I'm confident that it will be worth even more in 5 years' time, 10 years' time. Okay, so to wrap this up, it's really important for us to have an investment thesis so we don't fall victim to our emotions when we see the price of stocks fluctuating and bouncing around like they have this year. And instead, we can know exactly what we've bought, why we've bought it, and when we're going to sell. And that can make us really good, disciplined investors over time, which will produce much greater results throughout our investing careers. So I hope this has been useful to you, and if so, please give the video a like and let me know what kind of content you'd like to see next. Thank you, and I'll speak to you soon.